Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, earnings season is all but over, but that doesn't mean it still can't guide your investing by showing you where the real strengths are in the market and the stocks to avoid. I'll break down the biggest lessons in earnings this week, the best and worst stocks, and the trends you need to know about, along with important updates to shares of Intel, UiPath, and Walmart. But first, if you want to see the 5 stocks I'm buying for the next 30 years, my forever stocks, look for the link I'll leave in the description below. It's a free report I put together with the Motley Fool, some of the biggest stocks in my portfolio. These are the stocks I'm following in major multi-year themes, with one of the picks up 100% and the group up an average 94% last year alone. That report is totally free. You're going to see the first stock immediately, and they'll email you with the full report and the other stocks. It's an easy way to support the Let's Talk Money community and see some of my favorite stocks to buy, so look for that link in the description below. Back to our main topic though, and we're going to start with the bigger picture here we saw in the second quarter earnings, and then work our way through sectors, valuations, and then the companies that should be on your radar, and the ones you need to avoid. I know the bigger picture isn't as sexy as going right to the stocks to buy, but it's going to be so much more important on how you invest. And that's because it is so much easier to get that big picture right, seeing the general trend in earnings that could support the entire market, or the trend in each sector of stocks is a hell of a lot easier than trying to pick that 1 or 2 stocks that are going to outperform the rest. Being able to spot the bigger picture trends then is going to guide you into sectors or specific stocks that, even if you don't pick the very best out of thousands, you're still going to do well because you have the broader forces pushing your stocks higher. Stocks in the S&P 500 index reported earnings that were 10.9% higher in the second quarter from last year. That might not seem like much compared to a company like Nvidia reporting 122% growth, but it's still the best market-wide profit growth we've seen since the fourth quarter of 2021, when the economy was getting that pandemic stimulus boost. On a revenue basis, companies reported sales up 5.2% from last year, also a multi-year best, and the profit margin was solid here. Companies were able to translate that 5.2% sales increase into almost double that 11% growth in earnings. For the rest of the year, analysts do expect some weakness with only 5% earnings growth and 4.9% revenue growth in the current third quarter, which is going to be reported starting late October, but a rebound in the fourth quarter. Full-year earnings are expected up 10% on 5% sales, followed by 15% earnings growth and 6% sales growth next year. Now it's true, analysts never see recessions coming, and these forecasts will almost certainly be tamed down a little bit, but even 10% earnings growth a year is very good. In fact, only 3 years over the last decade have seen that 10% earnings growth, in 2007 and 2018, when those tax cuts boosted profits, and in 2021 when pandemic stimulus boosted pretty much everything. So even if those earnings forecasts do come down a little bit, this is still feeding into my view that that bull market will keep charging. Interest rates are set to start coming down this month, which will lower the cost to do business and the rates on those consumer spending loans. Consumers have trillions of dollars in untapped home equity, money market funds, and checking deposits that could be deployed when those rates start coming down, and corporate profits are looking pretty good. Remember this as we dig deeper into the sector level and company level results, that a rising tide is likely to lift all boats here, even when there are pockets of relative weakness. At the sector level, stocks in the utility sector did especially well, reporting earnings up 20% from last year, and were also the biggest surprise, which we'll look at next. You'd expect that kind of growth from these fast-moving tech stocks, which also put up 18.9% earnings growth, but stodgy old utilities, between hotter summers, colder winters, and the unquenchable thirst for electricity from AI, utility companies have been big news over the quarter. Here though, it is important to understand the difference between regulated utility companies, which have to wait for approval to raise their rates and usually only get a small percentage increase anyway, versus the unregulated and renewable power producers that can sell on the open market and are seeing the stronger gains. We also saw financials and healthcare stocks do surprisingly well, with earnings up 17.5% and 17% over the year. Now, I've been following the recovery in hospital operations as it pertains to healthcare REITs, those real estate stocks here, but it also looks that rebound is helping the entire sector. And that turned out to be the biggest surprise for the quarter as well, that strong earnings for healthcare stocks. Companies in the sector beat profit expectations by an average 8.7%, followed by utilities beating by 8.6% on the quarter. Now we're going to see some of the individual stocks in healthcare did even better than this, and the share prices have reflected some of that, but the larger trend is still intact. Companies in healthcare, utilities, and financials are on an uptrend in profits and should continue through the rest of the year. Now before we look at those individual stock trends, and so you don't get too excited, the market is priced expensively here at this point. Stocks in the S&P 500 are trading for a price of 25 times their earnings reported over the last year. That's that 5650 price on the S&P 500 index, divided by roughly 226 in earnings reported by those 500 companies in the index. That current valuation is well above the long-term average, a premium of 15% above this 10-year average PE ratio, right around 21.8 times. Now that's not terrifically overpriced and doesn't mean a crash is coming, but it is warning that market returns are likely going to be moderate between 7 to 15%, even on stronger earnings growth, because stocks are already starting from this expensive level. Now, it is important to remember that stocks don't fall just because they get expensive. There needs to be a catalyst to send those stock or the market lower, something like a surprise earnings or a news event. Now, barring that though, stocks tend to follow Newton's law that an object in motion tends to continue in that same direction. On a sector level, we do get some very interesting ideas on valuation. While stocks and technology continue to trade very expensively versus that long-term average at 29 times earnings, or about a 50% premium on their 10-year average, some of the quarter's surprise sectors are closer to fair value. For example, stocks and utilities are still trading under their long-term valuation. Stocks of financial companies and those in healthcare are within 15 and 19% of their long-term valuations as well, while consumer discretionary, stocks that have been getting hit lately on fears of that consumer slowdown, are also trading at their long-term average. Consumer stocks beat expectations by over 7% for the quarter and reported strong 12% earnings growth, so it could be an opportunity that the shares are still relatively cheap right here. At the company level, we saw two of the biggest surprises in insurance and financial services with Allstate and Discover. Each of them beat their earnings expectations by as much as 478% in the second quarter. We also saw Insulet, ticker PODD, smash forecasts by 370% as it proves that the fear of those weight loss drug effects on diabetes solutions is overblown. Insulet is up over 21% since recommending it on the channel earlier this year. In the utility space, Energy, ticker NRG, beat expectations by 124%. And is benefiting from that return of favor of nuclear energy and the AI power demand. Also here, Uber Technologies, ticker UBER, it's another one that I've been watching lately, beating earnings by 50%. Recently announced a partnership with self-driving leader Waymo that could mean strong revenue growth in the future. On the flip side here, there were a handful of companies that missed earnings in spectacular fashion. Caesars Entertainment, ticker CZR, missed its estimates by 550%, reporting a loss of 56 cents a share, and missing forecasts for the third consecutive quarter. Now, we're going to see this again next in our Q3 estimates, but I would be very wary of any travel or entertainment-related companies that missed earnings for the Q2 or guided lower for Q3 profits. Any company in that travel or entertainment space that wasn't able to translate the strong vacation trends over the summer into profits needs to be researched further because it could point to serious managerial issues. Also, here's something I'll go more into later. Intel, ticker INTC, missed its estimates by 80%, and is working with Goldman Sachs on strategic changes that can pull it out of this decade-long slump, but I'm not confident any good news is coming for investors. One of the most interesting reports here came from Lamb Weston, ticker LW, which is the largest supplier of French fries to fast food restaurants, and missed forecast by 38%, as well as guiding lower for the rest of the year. Shares of McDonald's, Wendy's, and Yum brands, those quick service restaurants, did relatively well over the reporting season, with McDonald's up 13% and the other two basically flat, which means most of the bad news was already priced into these stocks, but I think more could be on the way. That slump in French fry sales signals weakness in consumer demand at fast food, but they're still dealing with that operational problems as well, like higher wages and inflation. Companies also provided updates to their forecast for current third quarter earnings, from which we can also get some great ideas. Fortinet, ticker FTNT, has seen a 19% increase in its earnings estimates, and the stock has jumped 36% since its report. Cybersecurity is easily my favorite theme right now, not only for its strong growth, but also for the confidence in returns. Behind all the tech changes, the Internet of Things, and artificial intelligence is a booming and pervasive demand for cybersecurity. That's not going to change, and I'm buying shares of Zscaler, CrowdStrike, Palo Alto Networks, and bought shares of Fortnite before the earnings. Natural gas producer EQT Corporation gave us surprisingly strong earnings considering the price of natural gas is touching multi-year lows, and the stock itself is down 25% over the last year. The company beat its earnings estimate for Q2 and has seen estimates for next quarter rise by nearly 18% since the report. Now, I highlighted potential turnaround in natural gas stocks a couple of weeks ago, and The strong report by EQT makes it one of my favorites in the space. Not only did Lamb Weston miss its earnings estimates, but it also downgraded Q3 forecasts by as much as 50%, which could give investors further pause in those related fast food stocks. Thinking back on that travel theme here, the airlines also did surprisingly bad on guidance. Despite that very strong summer travel demand, American Airlines and Southwest have both seen their Q3 earnings estimates get crushed 95 and 196% since reporting. And this speaks to a much larger problem with the airlines than even consumer demand can solve. And here Boeing, it's kind of like the Intel of industrial companies, a once must-own company that lost its competitive advantage and without a workable plan to get it back. Boeing just can't stop making bad news and punishing the stock. Now looking at the stocks I'm watching for this week, C3.ai, ticker AI, is one of the last AI stocks to report earnings when it releases results on Wednesday, and the shares really haven't seen that bump many others in the space enjoyed. Valuation is good though at 7.6 times this year's expected sales, and the company is forecast to post 20% plus revenue growth this year and next. It's still operating at a loss, but has enough cash flow to push through next year, and any report that keeps that same growth trajectory is going to be good news. I've got 500 shares here, one of my larger positions in AI, will hold for that growth. ChargePoint Holdings, ticker CHPT, also reports Wednesday after rebounding 47% from June, but it's going to need to show investors continued growth. We have seen an increase in stimulus projects for charging infrastructure under that NEVI program over the last 3 months, and expectations for this year's growth of just 5.6% should be an easy beat. Forecasts for 29% growth next year are probably going to have to come down a little bit, but the shares are still ridiculously cheap here at 1.5 times price this year's revenue. The company doesn't have any debt due until 2028, so plenty of flexibility there, and the recurring revenue continues to grow, supporting that top-line growth. The stock has disappointed on earnings in the past, but I'm using any dips to add to my position. UiPath, ticker PATH, is another AI stock I'm buying. In fact, it's one of my larger positions, just over $50,000 invested, and up 7% so far. The company is dominating in that robotic processes theme and is already net income positive. Growth has slowed to about 8% this year, but valuation is solid at 5 times price to revenue, and the sales growth could accelerate. The company added nearly 2,000 customers in the year to its most recent quarter, and customers are being upsold into more platform products, creating that flywheel of growth. The big news Friday was Intel, ticker INTC, up 9% at one point after Bloomberg reported the company is working with Goldman Sachs to brainstorm potential strategic changes that could include a sale of the foundry business or just holding off on plans. I'm still avoiding this stock though, and don't see much good news coming from this. I called out the ridiculous dual strategy of foundry and design last year, noting that Intel couldn't do one right, and it could break the bank trying to do both at once. Now they want to sell their foundry and refocus on just that design, but who would want to buy the foundry side? Who would you want to compete against Taiwan Semiconductor, which does like 90% of the world's foundry services? Even if they could sell foundry, what would be left? A design business that hasn't had a competitive edge in like 10 years and was the reason for Gelsinger's foundry fiasco in the first place. I might sound harsh here, and we have made money on Intel in the past here. I turned positive late 2022, and we rode it 60% higher through last year, but it was purely a sentiment play on the investor hopes that the company could turn itself around. Now investors need to start seeing the results from that, and it's just not going to happen. Looking again at the big picture here with the SectorSpiders.com sector tracker, 8 of the 11 stock sectors did close higher last week, but with the typical bull market sectors, technology, consumer discretionary, and communication services not participating. Even in those sectors, though finishing lower, the majority of the stocks rose with only a few large losses pulling the groups down, showing an overall healthy market. For example, 43 of the 67 stocks in the technology sector did finish higher, and without the 7.7% loss on Nvidia and the 28% plunge in SMCI, the group would have finished higher for the week. Looking at the trends here, consumer discretionary and energy stocks continue to be the laggards for the year, with energy up 8.8% and discretionary up just 4.6% against a market that has run 18% higher over the year. While oil prices are likely to stay under pressure as record production oversupplies a slowing economy, oil stocks are still strongly cash flow positive with strong dividends. Consumer discretionary will also face pressure as long as there's a question mark on the economy and spending, but we're seeing some very good valuations on the group and individually there as well. Get your free report and see the stocks I'm buying for the next 30 years, my forever stocks, with the link in the description below. Or click on the video to the right and get weekly dividend income. I'll explain the new QDTE weekly dividend fund, pros and cons, and how it compares to the QYLD. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.